Dad, I think I'm ready to buy my first home.
Well, son, buying a home can be expensive for us dinosaurs. Do you have any money saved up?
Well, sort of. How much money do you think I need?
Well, that depends on which mortgage you go with, son.
Yeah, trying to pick out the right mortgage for you can definitely be an overwhelming process, especially if you are a dinosaur. Hey guys, I'm Mike, and if you recognize the characters from the intro, then you are most likely a millennial. If you're new to this channel, I just want to welcome you. The video you are watching is called the Home Buying Guide and represents part 4 of this series. So far, we've used this cool rug from the 90s to help describe the overall home buying process. And today, we're going to talk about the mortgage selection category. I'm going to start off by going through some of the different components that make up a mortgage. And then later, if there's time in the video, I'll give you 4 different mortgage options that are available to you. We'll discuss the pros and cons of each, and then can jump into Microsoft Excel to see which of these mortgages will save you the most money. Ready to help this millennial find a mortgage? Let's get it! Alright, so there's many different components that are involved with the mortgage. So before I go over the 4 most popular types of mortgages, let's go over the basics first. Okay, so first off, let's talk about the 2 different types of interest rates that come with a mortgage. There's fixed interest rates, and then there's adjustable interest rates. With a fixed rate mortgage, your monthly payments will remain the same throughout the life of the loan. And if we use today as an example, interest rates are super low now, so if you're able to lock in a low rate, then that can save you money on your interest payments throughout the life of your loan. On the flip side, if interest rates are high at the time of searching for a mortgage, then a fixed rate mortgage may be harder to qualify for, as your interest payments will be less affordable. And that brings us to adjustable rate mortgages, which is where your interest rates will change over time. So the advantage here is the interest rate on these mortgages are going to be lower than the rates that are offered on a comparable fixed interest rate mortgage. Meaning your interest payments are going to be a lot lower in the first few years of these loans. However, as time progresses, these rates will change and will eventually increase to the point where they are higher than the rates that are offered on a fixed rate mortgage. And so based on my research, if I could recommend a mortgage for this millennial dinosaur, then I think going with a fixed rate mortgage would be the better option, especially since interest rates are so low right now. And so now that we've talked about the different types of interest rates on a mortgage, we also need to think about how long we plan on making payments on these loans. So banks and mortgage lenders offer a variety of repayment periods for the types of loans they offer. 2 of the most common mortgages are 15-year and 30-year mortgages. And I think the easiest way to figure out which option will save you the most money is to jump into Microsoft Excel, and I can show you an example real quick. Alright, so I've already established that a fixed rate mortgage is the way to go when it comes to financing your home. So let's run through this example real quick. Let's say you need to borrow $200,000 to buy a house, and the average interest rate for a 15-year fixed rate mortgage at the time of making this video is 2.45%. Likewise, with a 30-year fixed rate mortgage, the interest rate is 3.22%. And the reason the interest rates are different on both loans is because with a 15-year mortgage, the lender is exposed to fewer years of risk, and in return, they offer you a better deal on interest rates. And so going back to our problem, in order to pay off our mortgage within 15 years, we will have to pay $1,329 each month. And in comparison, on the other side, in order to pay off our mortgage within 30 years, then we would have to pay $867 each month. And so we can see that when we compare both types of mortgages, it looks like our monthly mortgage payment is going to be a lot less with a 30-year mortgage than with a 15-year mortgage. But let's look a little further. Over the life of a 15-year mortgage, if we add up all the principal and interest payments we've made, then that means we would have paid about $239,000 in total. And likewise with a 30-year mortgage, if we add up all the principal and interest payments we've made, then that means we would have paid about $312,000. And so when comparing both types of mortgages, we can see that if you were to go with a 30-year fixed rate mortgage, then you would be paying an extra $73,000 in interest payments. Totally not worth it. I would rather have higher monthly mortgage payments and save money in the long run by going with a 15-year mortgage. So if we could give this millennial some advice, if he's looking to move out of his parents' house and buy his own place, then he should consider getting a 15-year fixed rate mortgage, as that will save him the most money in the long run. Now, there's plenty of 15-year fixed rate mortgages that are out there, but the four main ones that I plan on talking about are going to be listed here. And before I go into more detail about these four mortgage options that are available to you, I think it's important to break these up into two separate categories. We have conventional loans and unconventional loans. So when you hear conventional loan, think of a traditional mortgage that comes from a private lender such as a bank, credit union, or other financial institution. Conventional loans are not backed by the government, meaning your lender is the one that inherits all the risk, as there's no guarantee that they will be repaid 100% of the money they originally lent to you. For that reason, a conventional loan usually requires you to have a good credit score and a higher down payment as opposed to an unconventional loan. However, after taking into consideration interest payments and fees, conventional loans tend to have overall costs that are lower than unconventional loans. And if we take a look at unconventional loans, think of these as mortgages that are insured by the government. Meaning a bank or mortgage lender will issue you a loan, and then in the event that you don't repay that debt in the future, then the government will have to step in and repay a portion of that debt on your behalf. And I don't want to go into too much detail on this right now, as this is something I will cover more closely on the next video. But just know that most people are attracted to unconventional loans because you can qualify for a mortgage without needing a large down payment. And they're also ideal for people who have bad credit scores. On the other hand, the downside to unconventional loans is the total cost of your mortgage usually ends up being more expensive in the long run, as you have additional fees you'll have to pay throughout the lifetime of the mortgage. And so now that we have a better idea of some of the differences between a conventional and unconventional mortgage, in the next part of this video series, I'll go through these four types of mortgages and we can figure out together which of these mortgages are going to be the right fit for this millennial dinosaur. See you next time. And as always, stay frugal, fam. Hey guys, I just wanted to thank you for watching this video. Be sure to hit the subscribe button that's right above me. And then check out my other videos, which will be listed on this side of your screen. We'll see you next time, Frugal Fam.